Now, corporate issuers is the most easiest topic in the CFA level 2 curriculum. This topic, you can do it at the end, you can do at the beginning, you can do along with any other topic, or you can do, you can put up this topic anywhere. But I would recommend this topic to be done after FSA because of the some elements of financial statement analysis out here. So that's the reason why I've kept the flow where you do this topic after FSA. And it's a very light topic, so it's not going to take too much of time. Overall, you have around 5 to 10 percentage of weightage in exam. So you might get one or two vignettes, not more. Four readings as of now, and it's not complicated at all. Based on your level one knowledge, also you will be able to do most of the things. However, there are some minor, additional things which we can understand it in detail as we proceed. So let's start with the first thing, that is analysis of dividends and share repurchase. Correct? Share repurchase is also called buyback in many of the countries, or how share repurchase and dividends are similar or different. What is the impact on the company's financial statements like earnings or book value, and what should be done when, and what is a global trend. This is what we are going to learn in the topic. Okay, so let's start. In the first part, we'll discuss everything about dividend, and in the second part, we'll discuss about the buyback, and then we'll compare both. Got it? So let's start with the dividend part. Okay. First of all, there are different types of dividends. Many of you all must be aware. I'm not going to repeat this process because since I begin everything with equity in level 2, so most of these things are already covered there, right? Regular cash dividends. Cash dividend is where the company gives cash into your account, you being a shareholder of the company. These cash dividends are stable or increasing depending on the company's payout ratio or company's policy. But companies who pay regular dividends are perceived as a sign of consistent performance or consistent profitability. Dividend is considered as a positive news, right? Correct. But within the different spectrum globally, there are different trends of dividends. So the frequency of dividend payment differs. For example, in US and Canada, the dividend payments are quarterly, while in European and Asian economics, it differs also. So in Europe, it is semi-annually, whereas in Asia, including India and China, it is mostly annually. So dividend is paid once a year after the annual general meeting in the board of the board, right? But sometimes companies can announce an extra dividend or a special dividend, that's an irregular dividend. Correct? So this can be done by the company which is already paying the dividends or company which has never paid the dividend. That's called a special dividend. So it is paid under unusual circumstances. These unusual circumstances can be due to company restructuring like spin-off, that is demerger, or it can also be that company has suddenly make a windfall gain or a huge profitability. For example, many companies after the pandemic, because they could not pay enough, they could not reward the shareholders during the pandemic. After the pandemic, they declared dividends, right? A sudden dividend. So those companies which were not paying dividends, they also paid dividend. That's called extra dividends. Correct? The third is a dividend in crisis, that is called liquidating dividend. A liquidating dividend. This is the dividend given by the company where when the company is about to be liquidated or sold. Correct? So when the dividends are in excess of cumulative, or when the dividends are in excess of cumulative retained earnings. So basically companies paying off everything that it has, right? This is considered as a return, not on capital, but return of capital. What is this considered as? This is very interesting. Return of capital. That means company is giving back its money to its shareholders. That is called return of capital. This is what I call dividend in crisis. This is not considered as a positive sign, right? Then all the three dividends that I discussed right now, correct? The cash dividend, generally when it's paid regularly, or it's paid specially, or it's paid when the company is liquidated. These are all forms of cash dividend. But instead of giving cash, companies can also give dividends with more shares. So in the form of additional shares to all the existing shareholders. This is called stock dividend. Yes, because the company is rewarding you by not paying cash, but by paying shares. Correct? Now, so basically, if you already had shares, now you'll have more shares, and by doing this, company saves in terms of giving out the cash. So there's no cash outflow from the company. Shareholders get additional shares. However, the ownership of the company does not change because everyone gets this extra shares. Correct? So, what all doesn't change? The ownership doesn't change. Correct? The market value of the company is also unchanged. Why? Because, guys, when the company pays out dividend, its retained earning goes down, but its total equity remains the same. Why? Because the share capital increases. So the money is not going out of the company. So therefore, market value of the company remains unchanged. But because now there are more shareholders, the market price per share might go down. So this will remain same. This will remain same. Market price per share might decline. Understood, everyone? Right? This is the impact of stock dividend. Clear? Right? Now they've given an example about how this reflects, but you don't have to go in detail. Correct? Now, what do you think? Should the companies give dividend or not? Well, most of the investors want companies to give dividend, isn't it? Correct? Most of the investors want company to give dividend, and especially many of them desire cash dividend, right? Correct? Now, companies consider stock dividends desirable, unlike cash dividends. Why? Because by giving stock dividends, the money is still with the company, isn't it? Correct? So companies consider stock dividend desirable because they encourage long-term investing and may reduce cost of equity, because in this case, companies risk. See, company doesn't have to go back in the market and raise more capital, right? So stock dividend is actually considered a positive sign, of course, but companies benefit from stock dividend instead of cash dividend. Here, the companies do not have to pay out cash. The money stays with the company. It's like the money is reinvested in the company. So it reduces the company's cost of equity or cost of capital, to be precise. Understood? Also, since now there are more shares in the market, the liquidity of the company increases. That, of course, is a positive news for the investors, right? So, company's liquidity will increase. Stock dividend may also be used to decrease the market price. Yes, sometimes the market price is too high, like the stock of Tesla. So, stock dividend, or in fact, you can say stock split. Well, both are technically the same. You will realize that in a moment. Stock split, yes, stock split is also the same thing. It's like companies giving out more companies giving out stock dividend only, because in both cases the impact is the same. So whether the company does stock dividend or stock split, that can be done. One of the common reason of doing both is company share price is too high. So by doing the stock dividend or stock split, company's share price will reduce without actually the market cap affecting, right? These stock dividends are actually called as by various names. They are popular in China as well as India. I don't know why CFA Institute does not put India or any other country in the list. So they are very popular in many of the countries. In India, actually, we call stock dividend as bonus shares, right? So it has a different name in different part of the world. But overall, the impact is that due to stock dividend, the market value of the company doesn't change. However, because the company is paying out and the companies or the number of shares increases, right? So even if the cash does not go out, the per share price, market price per share, or even earnings per share might decline due to the technical adjustment in the denominator of having more shares. Understood? So it will effectively decrease per share. All your components of per share will decrease. Why? Because the number of shares, the denominator increases. Clear, everyone? Stock split, as I said, is same like stock dividends. Why? Suppose if I say 100% stock dividend, if I say 100% stock dividend, that means if you had one share, now you will have one more share extra, right? It's similar to 2 to 1 split. What is 2 to 1 split? 2 to 1 split is that if you had one share, now it will be split into two. So now you will have two shares. So the impact of 100% stock dividend and 2 to 1 split is same, right? Correct? It's just the mathematical difference, but you can match it. So stock split and stock dividend are perhaps both the same. In both the cases, companies issue additional shares. The market value of the company is not affected. Per share price will go down, making the stock more affordable to many investors. Got it? But stock split is also a sign that the company thinks that stock price is too high. So in order to reduce the stock price to make it more affordable, companies do stock split. Rarely, however, companies can also do reverse stock split. Reverse stock split is done when the companies want to increase the share price, and by doing so, everything will be opposite. Market price per share will go up, number of shares will reduce, however, market value will remain unaffected. Understood? Understood? They are very less likely done, especially as I said, in Asia, we use more of stock dividends, stock split or reverse stock split rather. Reverse stock split is rarely done in many cases, countries. And in fact, ironically, it was even illegal in some of the countries like Japan before a particular period of deregulation. So stock split is common, but reverse stock split is not common. Got it? Everyone? Clear? Right? Okay. Now, just to summarize, what is that you would prefer as an investor? Most of the investors prefer cash dividend, but companies, as I said, they prefer stock dividend. And why so? We have already discussed. In cash dividend, companies cash reduces, correct? So the cash of the company reduces. Total equity also reduces or goes down. Why? Because the company's equity, the money is going out of the company, retained earnings goes down, right? And because cash is going down, some of the ratios like which are affected with cash is current ratio, quick ratio, they will also decrease. And if total equity goes down, then the company's leverage, like debt equity ratio, they will increase because equity is going down. Understood? So these are all ill effects of cash dividend. Cash dividend is not going to improve your profitability or leverage of the your liquidity or solvency of the company. I'll repeat, cash dividend does not improve your liquidity or solvency of the company. On the opposite side, stock dividends leaves the company's capital structure unchanged. The capital structure remains the same. So there's no effect on the company's total equity. There's no effect on the leverage ratio. And since there is no cash outflow, there is no effect on the current or the quick ratio. Understood? Why? Because overall, there's no cash outflow. So cash outflow is zero and total equity is same with respect to stock dividend, or in fact the same with split. So basically stock dividend and split are more preferred by the company so that it does not affect its valuation. Clear, everyone? Got it? So these are the different types of dividends, right? Now, historically, companies have been paying dividends since many years, right? In fact, there was an era before the 1960s and 70s that companies, whatever earnings they made, they declared everything as dividend. Can you believe it? 100% of the earnings was paid out as dividend, right? And there are many theories written on the basis of dividend, right? Very acclaimed theory. So we are going to understand what are the theories for paying or not paying of dividends, right? So there are three major theories which will determine why companies either pay or don't pay the dividends. Very easy, but very interesting. One is a dividend irrelevance theory by Professor Robert C. Miller, sorry, Merton Miller and Franco Modigliani. This theory was called theory, Modigliani-Miller theory, right? And if you recollect, was also known for capital structure irrelevance. So same way that they said that capital structure does not affect the company's valuation, they say the same thing about dividend, that dividend has no effect on the company's stock price. Yes, that is my theory number one out of the three theory, dividend irrelevance. They said something very interesting, that dividend is a homemade dividend. What is this concept of homemade dividend? Very interesting. Now, hear it out carefully. It's all written here. But suppose if the company pays too much of cash dividend, which you didn't want it, right? Companies paying too much of cash dividend, which you didn't want it. Well, who's stopping you from reinvesting back into the company that dividend? Well, it's very easy, right? You can just reinvest that money which you don't need back to the company. No one's stopping you from it. So this way you can shuffle the extra dividend by reinvesting into the company, right? Same way, what if the company did not give you enough dividend? What if it was too small? In this case, they are assuming that you can basically sell the shares and create a dividend for yourself. Who's stopping you from that? So they are saying, how does it matter whether the company pays dividend or doesn't pay dividend? In fact, we also know that as soon as the company pays dividend, so before dividend, the company share price is 100. And let's say on the ex dividend date, you realize that the company is going to pay dividend of $2. So eventually the company's share price after dividend will be 98. So very important thing they were trying to say is that how does it matter if the company does not give dividend, what its share price is? 100. If the company pays dividend, its share price is 98, but you have $2 received in cash. So the value of the company or the benefit to the shareholder is exactly the same. It does not make any difference. But here some assumption they consider. They consider that there's no taxes, no brokerage, and you can divide the share in any fraction. Now, if these assumptions are held, then what it would make sense that whether the company pays dividend or doesn't pay dividend makes no difference. Understood? Therefore, companies which paid out 100% dividend right in the past or didn't pay out dividend in the past, they both were considered equal. Understood, everyone? This was the dividend irrelevance theory. That theory was so famous that not only for this theory and for many other work, Merton, Miller, and Franco Modigliani, they were awarded Nobel Prize in Economics. Yes. So they are Nobel laureates. Understood? Dividend irrelevance. So what does dividend irrelevance conclude? It concludes that whether you pay dividend or you don't pay dividend, it does not affect the company or the shareholders' wealth. Understood? Now, on the extreme opposite side, you have theory of these two guys who actually countered Miller and Modigliani. These two people were Myron Gordon and John Linter. Of this Myron Gordon, you must be very familiar with based on Gordon's growth, right? If you recollect what is Gordon's growth formula, Gordon's growth formula P0 is D1 over cost of equity minus growth, right? Well, if you rearrange that, you will get cost of equity is D1 over P0, that's dividend yield plus growth. Now, what Myron Gordon and Professor John Linter they said a theory of bird in hand. Have you heard that concept? Have you heard that saying? A bird in hand is better than two in the bush. Have you heard it? Have you heard it? Have you heard it? A bird in hand is better than two in the bush. That focus on what you have in hand rather than worrying about what is going to be received, isn't it? So focus on today, not in the future. This is a quote that we use to calm down people who are over worried about the future, right? So what does this theory mean? That see, companies giving dividend right now, correct? And if it doesn't give dividend, it will retain, and in the future it will be utilizing that in the project and you might get capital gain. So contrasting the dividend irrelevance, John Linter and Myron Gordon said that, hey, you know what will happen in the future, we don't know. Companies paying dividend, right? So better take it. Correct? So they said that investors don't care about the dividends policy since they create their own. This is what MM said, right? But here, these two guys argue that decreasing the payout ratio is not sensible. Why? Because investors are less certain of receiving future capital gains. They are not sure whether future capital gains will be received or not. They rather value what is paid now. So they place a higher value on a dollar of dividends that are certain to be received. So they appreciate certainty more. than something that is going to be received in the future. So they give more value to the current dividend rather than the future growth rate. So therefore, if you look at Gordon's growth formula also, they say that this is based, they base this argument on the fact that when measuring total return, the dividend yield that is D1 over P0 is relatively less riskier than growth. Remember, dividend is easy to predict. D1 is based on D0 plus growth, correct? And current price is always available. So they are saying this is less uncertain compared to growth, which is based on so many criteria. Growth is very uncertain. So less uncertainty means less risky. So they are saying investors perceive dividend as less riskier than the future capital gains. Understood, everyone? So that's why bird in hand is better than two in the bush. So therefore, dividend received today is valued more than the capital gain that is expected in the future. Clear? The two completely contrasting theory. Yes, yes, yes. Check, check, check. Understood? Right? And the last theory, which is very relevant today, is that in many countries today, dividend tax rates are very high. Okay. In fact, in the past, also the dividend tax rates went all the way to as high as 70% compared to capital gains tax, which were relatively less. And in fact, in many countries, capital gain tax for long term is much lesser than short term. So investors didn't want a dividend. Why? Because dividends were highly taxed in the past, right? So investors wanted company to retain and have no dividend payout, because the more the dividend was paid out, the higher it was taxed in the past. Correct. However, this rule was changed by most of the countries, and therefore, since 2003, what US also did is that they made sure that the maximum dividend paid is not too high. So they changed the dividend and long-term capital both at 15%. So now you no more have to pay more than 15%, whether it's dividend or capital gain. So this tax arbitrage doesn't exist anymore. Okay. But if the dividends are taxed highly, investors don't want to pay higher tax. So they will avoid the taxes. That's called tax aversion. Clear? So, a very interesting thing, which policy is better or which theory is more supportive or relevant? They are saying empirical tests are unclear. There is no clarity as to which thesis is right. Historically, and research says that higher tax rate do not result in lower dividend payouts. See this, higher tax rates, sorry, my mistake. Higher tax rates do result in lower dividend payouts. Definitely, if the tax rate is higher, right, companies would not want to pay high dividends, right? You will see in US also many companies, if the shareholders have the opportunity, they don't want the companies to pay out dividends if the dividend is against them. Now that, as I said, that arbitrage doesn't exist in US, but in many other countries it does, right? So first of all, if the tax rate on dividend is higher, no one wants cash dividend or no one wants dividend, correct? Now, still there are people and many categories of people, in fact, most of the people believe in bird in hand theory. They actually think companies which pay dividend, they consider those companies as a very positive sign, correct? So dividend paying stocks are loved by investors even after making them understand the theory that it is irrelevant. Understood? As I said, is on the opposite side. Says that it doesn't make any difference whether the company pays dividend or doesn't pay dividend. So everyone has their own view. And today, that's why you see many companies, like in the past, companies pay dividend. Now, no more companies are in the compulsion of paying dividends. They may pay or they may not pay dividends, right? So there's no compulsion, and therefore, not all companies are today paying dividends. Clear, everyone? Understood? Audit, right? Yes, yes. Let me show you a question related to this. The bird in hand argument for dividend policy is based on the idea. Yes, bird in hand. Okay, John Linter and Myron Gordon. of course, is based on the idea that dividend over price, that is dividend yield plus growth, is constant? No, for all policy, no. In fact, this portion is less riskier. A decrease in current dividend signals that the future earnings will fall. Possible, right? Bird in hand means today the dividend is more valued, correct? But is this bird in hand argument? Not sure. C, because of the perceived difference in the risk, investors value a dollar of dividends more highly than the expected capital gains. Yes, this is more relevant, isn't it, everyone? C is the answer, correct? Dividend is more valuable than the capital gains. I've got a question. If the company doesn't pay dividend, the shareholders only benefit from price appreciation only, right? Yes, to answer your question, does the company only benefit with share price increase if they don't pay dividend? Well, if they don't pay dividend, we are going to learn in this topic the other option, that is buyback or repurchase. So through that also shareholders might get benefit. But honestly, buyback, share repurchase or dividend. Apart from that, the only option that shareholders have is the growth. There are only two ways that you make money from the stocks, right? Either dividend or from the growth or both. If the companies are not paying you dividend, then you're only left with the share price increase. That's a good growth or capital appreciation, isn't it? Understood the question? That how does the company shareholders benefit if not dividend? Only through price appreciation. Clear? Yes. Now we will understand a concept further about dividend. Before we move to share buyback, we have understood the different theories of dividend. But what does the dividend signal? So this is signals of dividends. First of all, is it a positive or a negative signal? That depends on various factors. Okay. So first thing, information asymmetry. This is what you've learned repetitively in corporate governance also. Who has more information about the company? The shareholders or the company's board and management? Well, the board and management, everyone, the insiders of the company, they have more information about the company than the investors. Isn't it? Correct? So, what is the conclusion about it? So, dividends convey credible information to the investors. When the company is paying dividends, okay, that means the company, the shareholders perceive that as a signal by the board and the management that the company is confident of sharing this profit, and these profits are expected to be shared in the future also. That means they are sticky. What do you mean by sticky? That investors perceive dividend as sticky in the sense that they will be paid in the future also. So it is considered as a positive sign in most of the cases. Understood? Correct? Now here, management is very smart. They will not increase the dividend unless they expect to continue higher profits in the future. So if there is a sudden profit or a random profit, but it is not sustainable, then the dividends will not be increased. Understood? Correct. So see, management or the board is reluctant to increase the dividend, but they are also reluctant to cutting the dividends because they don't want it to go as a negative sign. So they don't want to cut dividends unless they think that this negative situation will persist. Understood? So most of the companies, the companies who want to give signal to the investors, they will perhaps give dividend consistently. Understood? So it's like a positive signal for investors, especially if there is information asymmetry where the company's insiders know more about the company than the shareholders. Clear? Second, the information conveyed by the dividend initiation is ambiguous. Now, see, again, when the information is not clear, then it is considered positive, right? But here we are discussing the information conveyed by the management can be both ways. It can be positive as well as negative. The company is optimistic that the future profits will be appearing, then the company may pay dividends, right? Also, some people call it as a negative signal that why is the company paying out dividends? Where does it not have enough projects to reinvest? So companies has lack of profitable reinvestment opportunities and it's paying dividend. That's a negative sign. This was evident with the Apple company, Apple Inc. In the past, in many of my lectures on YouTube, also, you will see that I have clearly mentioned that Apple, when it started giving dividends, that's where I realized that why is Apple giving dividends again? And I'll show you what's Apple's dividends policy over the last couple of decades, where you will see what's happening as a change in its policy. That was a clear sign that Apple doesn't have enough profitable projects, or if it does not have any creativity left anymore. So when the company doesn't have enough projects, it will do what with the money? It will repay it back to the shareholders in the form of dividend. So dividend paying can be considered positive as well as negative sign, both. Correct? Third, unexpected increase or decrease in dividend. Okay. Now this is a surprise. So unexpected increase, of course, considered as a positive sign, a strong sign of positivity that the company and the management is confident that the company's profitability will increase. Therefore, they have taken the strong position of increasing the dividends, right? Studies have found that companies with a longer history of dividend increase are dominant in their industries. Therefore, you will see power companies, oil and gas companies, most of the government companies, they regularly pay dividends and they increase the dividends. And when they increase the dividend, that's a very positive sign. Correct? On the extreme opposite side, company which has been constantly paying dividend and suddenly it may stop paying dividends, it can be two ways. First of all, if it has suddenly stopped paying dividend, the first intuition of people will be like, what's wrong with the company? Why is the company not paying or paying less dividend? Is there something wrong with the company, or why is the company not having enough profitability? Shareholders will start questioning the company. In fact, I forgot, but I'd been to one of the company's board meeting, and where the board had decided not to give more dividends compared to last year. And I saw the shareholders yelling at the board. I forgot the company, but I had myself experienced it in one of the hotels in Mumbai where I went to the AGM. So shareholders become very angry when the companies don't meet their expectation of dividends. But sometimes the companies might have a genuine reason of not giving dividends, is because there is something positive coming up, because they might have bagged a huge project for which they don't want to go out and raise additional capital. So see, giving dividends and then going out in the market and raising capital is stupidity. So in such a case, company will prefer to retain the money rather than pay dividend. So that, in rare circumstances, it can be considered as a positive sign. Understood, everyone? Clear? Right? Okay. Now we all are aware about agency cost. What is agency cost? Remember, the company is run by the management. The investors appoint the board of directors, right? So investors means shareholders appoint the board of directors, who will then oversee the management about the performance of the company, right? So there is a conflict, which we have learned in level 1 corporate issuers also. There is a conflict between the shareholders and the managers, correct? And between the shareholders and the bondholders also. So between the shareholders and manager, the issue what we have either through board or to directly is what we call as a principal agent problem, right? Now here, what is the cost of that to the company? See, understand this thing. This reflect inefficiencies due to divergence of interest between the managers and the stockholders. See, stockholders always are diversified. They are not invested only in one company. They might be invested in many companies. Correct? So managers may have an incentive to over invest. Why? Because majority of their compensation probably is tied in the profitability of the company's share price, or increase of the company share price, right? So they don't have anything to lose if the companies don't create high share value. So in such a case, managers might become over risk taking. They may take excessive risk, right? In what way? They may also take the projects which are very risky, which may eventually destroy the wealth of the company. So in such a case, what should the company do? One way to reduce agency cost is to increase the payout of free cash flow as dividend. So they are saying if majority of the money or the free cash flow is distributed as dividends, there is very little amount left in the hands of management to destroy or misuse. Understood, everyone? Correct. So that is one of the solution. But however, mature firms see this. However, mature firms in relatively non-cyclical industries do not hold cash. Mature companies like oil and gas, where or if the business is stable. Okay, oil and gas is cyclical. So let's say mature companies like power companies or distribution companies, where their cash flows are where their business is relatively stable. In such companies, they don't want to keep holding the cash, the regular cash. They give regular dividends. So you always look out for mature companies and non-cyclical companies. They always pay higher dividends. And if they pay higher dividend, that's considered a positive sign by the investors. Otherwise, they will start doubting why is the company not paying out dividend when it is consistently generating the cash flows, right? So, first of all, to reduce the agency conflict, to keep more, you should avoid keeping more money in the hands of management. And by how? By paying out as dividends. So, to avoid agency conflict, also companies declare dividends. Understood? Between bondholders and shareholders, see, debt holders don't want the company to be paying dividends at the cost of the bondholders' interest not being paid. So there's always a conflict where the shareholders want more dividend, they want to take more risks, bondholders don't want to take risk, and they don't want large dividend payout. Yes. So bondholders don't want the company to be taking excessive risk and large dividend payout. So how can we resolve this? Well, bondholders have the right that when they are subscribing to the bond, they look at bond indenture, which is the contract, and under the bond indenture they can put what? Covenants, remember, everyone, covenants. So through covenants they can make sure that, through covenants, positive and negative covenants, they can make sure that dividends are not paid to the shareholders until interest is paid on time, and various other restrictions they can put on the equity shareholders. Understood? Those are called covenants. So through this covenants or through paying out of dividends, there can be resolution of the agency conflict. Understood, everyone? Clear. Okay. Now we will understand the 6 factors, everyone, that the management or the board keeps in mind when they want to give dividends. So what are the 6 reasons or factors which will decide whether the company will pay dividend or not? And one of that issue is taxes, and we have questions related to taxations. Okay, so stay tuned for understanding this concept because it has calculation also coming up, right? First of all, company's dividend policy is the approach of the company follows. Every company has a payout policy or a dividend payout policy, right? Or a long-term dividend payout ratio in mind. Same way, the company has a target debt equity ratio in mind. They also have a dividend payout ratio in mind, which they want to maintain or they want to achieve in the long run. Understood? Correct. So, how much amount and when the dividend will be paid, this is generally, a part of the company's policy. Understood? So they say that there are 6 factors that the companies will consider while making such policy. Number one is based on investment opportunity. Tell me one thing, if there's a huge project coming up, will you prefer to pay more dividends or less dividends? Everyone in the class, correct? So if there is huge opportunity coming up, correct, then the companies will pay out less dividend. Perfect. Correct. Right. Yes. Now, same way, if the company's earnings are expected to be volatile, and in this case, companies will not increase or decrease the dividend randomly. So what companies generally prefer to have, they prefer to have a target payout ratio. What is the payout ratio, by the way? Payout is dividend over earnings. which is DPS over EPS. So we have a target payout ratio. In this case, what happens that here your dividends will change with in accordance with the earnings, right? But the payout ratio will remain constant. So firms tie their target payout ratio to long-term sustainable earnings and are reluctant to increase dividends unless the earnings are also expected to increase. So guys, even if the earnings are volatile, what will happen? Companies will not try to change their payout policy. Why is that so? Because they would want to maintain the payout in good times as well as bad times. So you don't want to be paying out extra dividends in excitement when the markets are bullish, and you don't want to cut down on dividends when the markets are bearish. So generally, most of the companies try to maintain a target payout ratio which goes in sync with the earnings. Understood? Correct? The third is financial flexibility. Now tell me, if you are the CEO of the company, CFO of the company, right? And you have excess cash, correct? But this excess cash, if you pay out as dividends, what will happen? Shareholders will demand dividend every year, isn't it? Correct? You can't control them. Once you pay dividend, they start demanding the dividends every year, isn't it? So, to not get entangled or to not get into that trap, companies prefer stock repurchase instead of dividend. This is what I'm going to show you very soon, what Apple exactly did. Because stock repurchase or buyback, which I'm going to show you later, is not considered sticky. Means once you do buyback, investors don't always think that companies will do every year buyback. No, they are not thinking that companies will do every year buyback. But if you pay them dividends, surely they think, yes, company will had paid last year dividend, this year also they will pay dividends. So if you pay dividends, you lose the flexibility. But with this excess cash, if you rather do what, instead of paying dividends, if you do it as a stock repurchase or buyback, and if you do that instead of falling into the trap of dividends, you have more flexibility, and then you can use this money according to the opportunity available. Understood? So this is very important, correct? Especially in the times of crisis. Otherwise, you will be forced to pay dividends. Got it? Right? Clear? Everyone? Okay. Now, I'm going to show you something related to this, and then we'll do taxation, flotation cost, and other things. Or let me first complete this, and then we will see what is the issue. So I'm going to discuss about taxation issues, and then I will show you what is Apple doing with respect to this financial flexibility. I'm very excited to show that, right, which I had recently spoken in one of my sessions also. So, first of all, what are we discussing? We are discussing the factors that companies take into consideration while deciding their dividend policy. It is the investment opportunities available, volatility of earnings, financial flexibility, right? And then there are three more factors. One is tax consideration, which we've already discussed, that like company investors are also concerned with after tax returns, and in most of the countries, capital gains tax are lower relatively compared to dividends, which are generally taxed in many countries at the respective tax rates. So in such cases, companies will also be not be willing to pay more dividends and charge their investors with more taxes. Correct? But there is one very interesting discussion that they've done here, which I would like to highlight. Okay, this is completely different from what is mentioned here. They are saying that a lower tax rate, if the tax rate is lower, see, if the tax rate is high on dividends, definitely the company will be reluctant to pay more dividends, correct? But they are saying a lower tax rate does not guarantee that the companies will raise their dividend payout. No, 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 no. They are saying that, okay, higher tax rate, we understand companies will not pay more dividends, right? Correct? But the lower tax rate is no guarantee that the company will raise the dividends. Why is that so? Because stockholders may not prefer higher dividend payout even if the tax rate is low. They have given multiple reasons for it. Very interesting. First of all, taxes on dividends are paid when dividend is received, which is generally every year. But guys, when will capital gains tax happen? That will only happen when you sell the share, maybe after 10, 20, 30 years if you're going to hold it for long. So dividend tax is paid more frequently than capital gains tax. So therefore, I don't want my returns to be in the form of dividend and pay tax earlier. That is one very interesting reason, isn't it? Second, the cost basis of shares may receive a step up in valuation at the shareholder's death. Yes. See, when you will go to level 3, you will understand this concept that when someone dies, the wealth is transferred to the next generation or the generation after that. But in US, you have to pay estate tax, correct? Now, guys, suppose if if I bought a share at 100 and at the age of, let's say, 20, and at the age of 70, if I sold the shares for 150, example, I made a 50% gain. So I'll pay tax on it. However, fortunately or unfortunately, I don't know, if I died at the age of 50 and then the share price at that point was 130, then my share being transferred to my kid, she will receive the share at this point. So her cost basis is now 130. So suppose if she sells the share after 20 years, she will be paying the tax only on this 20, not on this entire 50 percentage. So that's called a step up, which happens because the wealth was transferred to the next generation. This means taxes on capital gains may not have to be paid. Of course, if that money is going directly, then and she's selling at 130, she might not have to pay tax at all. Understood, everyone? So there's a step up in valuation which will save taxes, and therefore this is also considered one of the reasons. Clear? Right, everyone? Next, what is the next reason? Tax exempt institutions such as pension fund and endowments, well, whatever income that they get is generally tax free, right? Correct. So for them, it actually makes no difference whether the company pays dividends or whether there's a capital gain. So due to these reasons, even if the tax rate on dividend is less, investors are not too excited for companies to give dividend. They would rather want to avoid dividend in most of the cases. Got it, everyone? Right? Correct. Also, now understand flotation cost. Whenever a company wants to raise capital through investment bankers, they have to pay 3 to 5 percentage, or maximum they've said here 7 percentage in many cases, depending where you're raising the capital. So if you want to raise $100 million of funds, you have to pay these many amount, this percentage, which is a very high cost, by the way, to the investment bankers and other fees to the merchant bankers. Now, this is what you have to do when you go to raise the capital from outside. Now, instead of that, what if you utilize your own retained earnings by not paying dividends? So you don't have to pay flotation cost for it, right? The retained earning has no flotation cost. So if the flotation cost is too high, flotation cost is the cost of issuing the shares, right, in the market, the book building cost, or the merchant banking legal fees, blah blah blah, all these fees, all the cost of issuing the IPO, that is a flotation cost. If the flotation cost is too high, why would you want to pay dividends and then go and raise capital? Rather, don't pay dividends and retain the amount. So this can also be one of the decider of the dividends policy. And the last but not the least, contractual and legal restriction. Yes, there are two laws which will decide your dividend policy. One is the impairment of capital, where in some country it is compulsory that the dividends cannot be in excess of retained earnings. Yes, company cannot pay huge amount of dividends that will stop company from getting liquidated. So company cannot pay dividend more than it retain earnings. That's a rule in most of the countries. But on the contrary, there is another rule, that is debt covenants. Rules put up by the debt covenants, which I just discussed, to protect them so that they cannot give more dividends unless the company meets some of the financial performance criteria like liquidity ratios or coverage ratios. Only then the company is allowed to pay dividends. So due to this, company might be forced not to pay dividends. These are some of the reasons that will decide the company's dividend policy. Of this, one of the reason I discussed was financial flexibility, which we are going to talk in detail. But what did I mention here? That if the company wants to be flexible enough in their decision making of how to utilize the cash, will it go for dividends or will it go for buyback? Buyback means repurchase. Will it go for dividends or will it go for share repurchase? What will the companies prefer to do? Please tell me. What did I discuss? It will go for share repurchase, right? If companies had the option, because I told you that if the companies give dividend once, shareholders will start demanding every year, isn't it? Understood this part? Now, do you think overall, again, companies paying dividend is a positive signal or a negative signal? Tell me something. Positive or a negative signal? Yes, friends in the class, what do you think? Dividend is a positive? Okay, in between. Trust me, before the lecture, most of the students thought dividend is a positive thing, right? Correct? Now, gradually you realize that really dividend is positive? I don't think so. Or maybe I'm not sure. Understood? Now, what do you think? I'll show you the numbers. What do you think Apple does? Apple Inc., which we all use the product. The reason I take Apple as a reference because of one of the largest valuable companies, and also because we all are seeing the growth of the company right in front of our eyes and we are utilizing its product, right? So tell me one thing. What do you think Apple is paying dividends or not paying dividends? Paying dividends or not paying dividends? Well, let me show you some interesting thing. Okay. This is Apple's dividend history. Visible? Is it visible? Check. Apple's dividend history? Yes. So I've pulled out the data of Apple right from the beginning for very long. You will see regular cash, regular cash. You see here regular cash, regular cash, regular cash. Every year Apple has been paying regular cash. But have you noticed something? In October 6, 1995, company paid regular cash as dividend. Then they just did split, and then all the way back, that is after 17 years, in July 24th, 2012, is where they again started paying cash dividends. After 2012, they have been consistently paying cash dividends, whether they like it or they don't like it. You see, there is a huge gap, which again, no one will tell you. There's a huge gap that after 1995, right, they did not pay dividend till 2012. Okay, I might be wrong, maybe, but I just see what is there on the SEC report. Based on that, I'm making the conclusion. Is it visible? Okay. Do you want to know something more interesting? What happened? Do you want to investigate what is the reason that Apple did not pay dividend during this year? So when did Apple started paying dividend again? Hello, everyone. What did you notice? When did Apple started paying dividend? From 95 till 2012, they did not pay dividend, right? So from 95 to 2012, are you interested in knowing what happened and why was Apple not paying dividend? Yes. Yes. Okay. Steve Jobs died in October 2011. He died in October 2011. Till that, with the way this guy was, he didn't believe in the company paying dividends. As soon as he died, okay, from the next year, company started paying dividends. Why? Because it succumbed to the shareholder pressure that pay dividend, pay dividend, pay dividend. Steve Jobs was a guy who said, why do you want to pay dividend? I will give you good growth in the company. Let me put this money into innovation. But that was Steve Jobs. The company was growing, the product was amazing. It is still amazing, but not that was a revolution which they caught up with at that time. And then people were in a way, okay, whatever money you have, utilize it for creating more wealth. So people were not, forcing. And of course, Steve Jobs, as the guy he was, people didn't even dare to ask him that, hey, give us dividend. He'll be like, okay, you know what? Do hell. He is a much stricter version of Elon Musk when it comes to his own company decisions. That is what I can tell you from the way I looked at his journey. So only when he died, that's where the shareholders, activist shareholders came up together, like Carl Icahn, David Eisenhower. These guys came up together, forced the company to declare dividends. Till he was alive, no one did that. So that's where you will see Apple is paying regular cash dividend ever since 2012. Even though, if you ask me, Apple does not like paying out dividends. It wants to utilize this money for more reinvestment. However, Apple has been struggling with innovation and creativity of late. This is what I believe. And they have had some very bad projects, some like Apple Car or Apple TV, which is not giving them the results that they desired. And I see the global sales of Apple products also falling, especially China. So Apple is now not having enough opportunities. So what should I do with this billions of dollars of cash? Rather pay out as dividends. Understood? Correct? But what am I trying to relate it with the topic? Once you pay dividend, done. Now you don't have a choice. Now you have to keep the shareholders happy and pay dividend regularly. Apple fell into that trap. It did not pay dividend for 17 years, but once it started paying, then it has no control. It has to pay dividends. This is what I see from my point of view. You can have a different point of view, but since then, Apple, whether it likes it or it doesn't like it, it has to pay dividend. Understood? So it has actually lost that flexibility. Clear, everyone? Understood the concept? Got it? Okay. Yes. Now, dividends, what we also studied probably in level one is that companies pay profit, correct, at the corporate tax rate on its earnings. But when these earnings are distributed to the shareholders also pay the taxes. So actually, it's like a double taxation, which is not liked by many investors, but this is the fact that because the taxes are first paid by the companies on their earnings and then paid by the shareholders, again, that's a double taxation. Due to this, the effective tax rate now has two components: the companies which pay the corporate profits, and from that, whatever is remaining, I pay the tax on the dividend distributed. Of course, this was not accepted by many investors in US, and of course, they brought a new legislation in US where the maximum tax payable is now capped to 15%. So now the double taxation issue no more arises. But still, in many countries, people end up paying double taxes. Therefore, your effective tax rate might be much higher. This effective tax rate is the first thing we are going to calculate now. Effective tax rate. Now, what is effective tax rate? First of all, we are going to understand how to calculate effective tax rate under the double taxation system. Double taxation system. Now, under this system, first, my effective tax rate, ETR, I'm writing short form, is that your company, you means your company is going to pay up the corporate tax, correct? So, corporate tax rate is what your company will pay. Eventually, you will end up paying. However, whatever money is left after paying the corporate tax, on that, of that money, whatever is distributed, on that you pay the dividend tax, isn't it? So from corporate tax rate is one tax plus whatever is left from this corporate tax rate, correct? On that, individually, I will end up paying what? When the company distributes money to me, I will pay the dividend tax rate. And dividend tax rate is generally nothing but the individual tax rate that every individual has to pay depending on their tax slabs. Okay. So into the, you can write the dividend tax rate or individual tax rate into the individual tax rate. This is what will be an extra tax. So first, my company is paying the tax, and then I am paying the tax on whatever money is distributed. That's the effective tax rate under the double taxation system, everyone. So let me show you this. See here, a US company, and by the way, the formula is out there. Effective tax rate is corporate tax rate plus whatever remains on that individual tax rate. So US company earns earnings of 300, corporate tax is 35%. So first you will pay 35% on this. So you will be left with this. Now of this, they are saying 100% is paid out at earnings, and on that there is a 15% tax. So you will pay whatever is distributed on that 15%, you will pay taxes. So basically you have paid 105 also, and you have your company has paid 105 on your behalf as a corporate tax, correct? And then on its earnings, and then you will pay the dividend tax based on your individual tax rate. So overall, out of the $300 was whatever the earning was, you paid this and this as taxes. When I say you, means either you or your company or both, right? This is called double taxation. So here, whatever is the money that is being paid out as taxes, you can either calculate 300 minus the after tax value, or you can just take both the taxes. You can add both the taxes. So that is 105 plus 29.25, that is 134. Together this is 134.25 on the earnings of 300 into 100. That will give you your 44.75%, which is actually the same thing as the formula. What was the formula? My effective tax rate, of course they've given here, is my corporate tax rate, which is 35%. So check out, this is 35%. Now how much is the balance? Balance is the 65%. On that you will pay 15% as the tax rate. So this will also give you the same answer. You can verify this. So you will do 65% on 15 or 15% on 65%. You can say whatever way you calculate it, 0.15 into 65% plus 35, you will get exactly same 44.75, whichever way you do it. That's called your effective tax rate under double taxation system, correct? So even though the corporate tax rate was just 35, but you ended up paying much higher because first the corporate pays tax and then you pay the tax on the dividend. Clear, everyone? Now, this was revolted by many investors, prominent investors in many countries, and therefore, in some of the countries, they brought a slightly better system, which is called a split rate corporate tax system. Yes, it's called a split rate system. So what is a split rate system? First of all, this is the double taxation system, right? Which today many of the countries still have, by the way. But just to make the investors cool down a bit, now you have a second system, which is called the split rate taxation system. I'll write down here. It's called the split rate taxation system. This is second system. Very interesting system, right? What is this system? Again, the formula is perhaps the same, but very interesting thing will happen. See this. Here the earnings distributed is dividends at lower rate than earnings that are retained. Yes, so the taxes on what is distributed, so dividend tax is actually lower than the earnings which are retained, than the earning which is retained. So due to this, what happens is that there is a special tax rate in case if the company is paying out dividend rather than a higher tax rate when the company is retaining. This effect is to offset the double taxation issue, correct? Germany had a split rate system until 2009. So in this case, what will happen? The calculation is exactly similar, just that the corporate tax rate now will be different for the distributed income. How is this going to be different? Let me show you this. Again, it's the same thing, no big difference here. See this. German companies' annual pre-tax earnings are same, 300. Corporate tax on retained earning is 35. So if the company is retaining, like here, whether retained or paid, it didn't matter. The tax rate was 35, right? Here also it's 35. However, if the company is planning to pay dividend, then the corporate tax rate now changed to 20 percentage. Correct? Assuming the company is going to pay out 50% as dividends and the individual tax rate is 30 percentage. Individual tax rate initially here, what happened? Individual tax rate was 15 percentage. Now it has been increased to 30 percentage. So now we will calculate the effective tax rate. The formula will not change at all. But now instead of taking the higher tax rate of retained earnings, we will take the tax rate on a special tax rate if the company is going to pay out dividends, right? So my now effective tax rate here, you will notice, is 100. It's exactly, you know what, I will show you that what is the difference if the company follows the split system and if it has the general double taxation system. So see, imagine the company had $100 in both the cases as earnings, right? In the split system, there is a special, if the company is going to distribute dividend, then it only has to pay 20. But here, the company is not having a special tax discount. So here, the company will have to pay the entire 35 as taxes. So what remains here is 65. What remains here is 80. Here in this in the split system, the dividend tax that I'm supposed to pay, that is that they have said is 30 percentage. So 30% of 80 is 24. So I'm eventually left with how much, guys? 56. 56 is what I'm left with. So can I say the tax that I paid was 44? So 44% is going to be my effective tax rate under this system. Under this system, I am going to pay taxes on the dividend, and they said me the dividend tax rate was 15 percentage. So 65 into 0.15, that is 9.75. 9.75 minus 65. 9.75 minus 65. This will be 55.25. I'm left with 55.25. So out of 100, if 55.25 is what I'm left with, I have paid how much, guys? 44.75 percentage as my effective tax rate. Now you will notice here, in one case, I had 44.75 double taxation, and here I have 44%. Formula is just the same, no difference. Understood, everyone? Correct? Just that this corporate tax rate might be lower if the company is going to pay dividends. Understood, everyone? Correct? This is like a scheme came up by the government in case of avoiding people from paying high double taxes. Got it? Understood? Now, there is one more system apart from double taxation and split rate taxation system. What is that system? That system is called the imputation tax system. This is my, out of the two, this is the third one, which is the easiest of all. The easiest of all. Why? Because here you actually don't have to do the calculation. First of all, in this system, taxes are paid at the corporate level, but are attributed to the shareholder. What does it mean? That, see, if the company is paying up some taxes, and if as a shareholder you fall in a tax bracket which is higher or lower than the corporate tax rate, then there is an adjustment. So all the taxes are effectively paid at the shareholder rate. What do I mean by that? See, here, see, what is the tax rate? The corporation. Cornelius is in 20% tax bracket, and Todd is in 40%, and company has to pay 30% tax rate. So individual tax rates are 20 and 40, and the corporate tax rate is 30%. Now here, the company is paying 30% tax for both the guys. Okay, correct. But remember, this guys falls under 20% tax only. So the company has paid 30 when the shareholder is supposed to be paying only 20. He falls under the 20% tax bracket. So here, what will happen if the company is going to distribute the dividends, right? The shareholder is supposed to pay only 20, but the company has already paid $30 tax. So in this case, the shareholder will actually receive the benefit. So the shareholder will receive the benefit. Yes. So see what is written here. Shareholders deduct their portion of taxes paid by the corporation, and if the shareholder tax bracket is lower, then shareholder will receive a tax credit. So in this case, he will receive a tax credit because his tax is relatively lower than what the company paid. So eventually he has to pay only 20. So his effective tax rate will be same as his marginal tax rate. Similarly, if the shareholder was under a higher tax bracket of 40, but the company paid only 30, so the additional 10 will be paid by him, making sure that his effective tax rate is same as his marginal tax rate. So under the third system, which is called imputation tax system, imputation taxation system, again, here you actually do not have to do any calculation. Why? Because whatever is the extra that is adjusted in such a manner that the effective tax rate is equal to shareholders marginal tax rate, means the shareholders actually income tax rate. Understood? So it's exactly has to be the same. If you paid more, you'll get a tax credit. If you paid less, then you will have to pay that difference. Understood? Let me show you all three through the example out here. See, Klaatu is a country that taxes dividends on double taxation basis. So the first country is based on double taxation. Barada is a country that has a split rate, and Nikto is a country that is based on imputation taxation system. So I will write down this. Klaatu has a double taxation, correct? Barada has a split tax system. And of course, the third one, Nikto, it has a imputation tax system. Understood? Apologies for my handwriting, correct? Okay, so see, first of all, my effective tax rate, they have asked me here the effective tax rate, right? So for effective tax rate percentage, I need the corporate tax rate. What is the corporate tax rate? The corporate tax rate they have given is 35%. So I'll directly jump to 35% plus 1 minus 35, that is 65%. And on that, I am going to pay up the tax. Which tax rate, guys? Let's see this. They have said Luca's pre-tax earning, okay, 2, and the company's payout ratio is 100%. Investors' individual tax rate on dividend is 30%. Yes. So let us see what is our effective tax rate now. So 65 into 0.3 plus 35. Are you getting 54.50%, everyone? That's going to be my effective tax rate. Check, check, check. Let me know if you're getting this. Everyone, are you getting 54.5? Yes. Okay. Now see, in the split system also the formula is the same. There's no change in the formula. Effective tax rate is going to be corporate tax rate, but now the corporate tax rate might be different if the company is going to pay out dividend. Yes. They said pre-tax earnings. Okay. Okay. First we will read there. Barada is a country that taxes dividends based on split. The corporate tax rate applied to retain is 36. We don't need this. But if the company is going to pay out earning as dividend, then it is only 20%. So here it will be 20% plus 1 minus 20% is 80%. Yes. And on that, the individual tax rate for dividend is 28 percentage. Got it? So now I will do 80 into 0.28 plus 20. Are you getting 42.4? Check, check, check. Yes, everyone getting this answer? Correct? Check, check, check. And then the imputation tax system, in this, I don't even need to calculate. They have asked these two guys, Jin White and Langels. White is in 25% tax bracket, Langle is in 42% tax bracket. So guys, whatever is my individual tax rate, that will be my effective tax rate, right? So they have asked me what will be the effective tax rate. Can you please answer A, B, C? No need of calculation here. Very easy. What should I answer? Well, it will be same as effective tax rate. It has to be C, 25% for white and 42% for Langers. Understood, everyone? Clear the tax system? Got it, everyone? Check, check, check. This is where we complete the first part of the topic, which is related to dividends. The second part of the topic is related to share repurchase or buybacks. Very interesting. We will see the impact of buyback on the company's earnings, book value, and then we will actually compare cash dividend or buyback. Which is better? What does it signal? And then we will see its impact, that how the buybacks are executed and what impact it will have on the ratios. This will be our second part of the journey. We will discuss everything about buyback and then we'll compare both. Clear, everyone? Understood till this point? Check, check, check. Stock buybacks. Before we move to stock buybacks, everyone cleared about the dividend part? Got it? Check, check. Yes. Now, remember we discussed that when the earnings are volatile, what will be the company prefer to do? The companies will prefer to maintain the payout ratio. Correct? This is what we discussed. So, what is the payout ratio? Payout ratio is how much of the earnings companies are willing to pay out as dividends. Now, before we jump into the share repurchase or buybacks, okay, let us discuss some more detail about this payout ratio. So, there are two types of policies that the companies prefer. One is the target payout ratio adjustment model. Here the companies might adjust the payout, okay? And the second, which is very rarely used and very theoretical, is a constant payout ratio policy. What does it mean? That generally when I say the payout ratio is constant, so irrespective of whether the earnings are decreasing or increasing, the payout policy is constant. Now this means it's very strictly followed in the sense that let the earnings be anywhere, the companies payout of dividends will go in tandem with the earnings. So, and that payout ratio will not change. So whether the earnings are increasing, the dividend will go in favor of that. So for example, let's say the payout ratio that the company's decided is 50%. So whether your earnings are high or low, 50% of that will be paid out as dividend. Now, this is theoretically, it's very easy, but it's very rarely practiced. In reality, no company follows the payout policy strictly. Sometimes they have to give more or less dividends. So they don't want to, or they can't actually time out it in a manner that every year the payout ratio is followed. So what they do is that they gradually adjust themselves to the payout ratio. Got it? So stable dividend policy focuses on payout ratio, as we said, and companies have the payout ratio in their mind, which is called the target payout ratio, but they want to achieve this in the long run. So in the short run, it's okay if it deviates, but they want to make sure that it meets the long-term expectation that they have about the earnings growth rate. So the payout ratio might deviate in the short run, but it will gradually move towards the long-term rate, not immediately, gradually. So, what will the companies do? If the companies think that currently my payout ratio is far away from the long term, then it will adjust and pay slightly more dividends. Yes. See this. If the company's earnings are expected to increase and the current payout ratio is below the target, then companies will be like, oh, okay, my current payout ratio is very low compared to the target, and I'm not expecting a fall in the earnings, I'm expecting a rise in the earnings. So let me give slightly more dividends so that I come closer to the long-term payout ratio. Yes. So investors can estimate the future dividends through the following. Now, this is where we are going to understand two things. What is going to be the expected increase in the dividends for this adjustment, right? And what will be the new dividend, or what will be the expected dividends. So I'm going to write down here the formula of what we are expecting. We are expecting a target payout adjustment model. This is target payout adjustment model. In this, even though you all know already, but I'm first going to write out what is payout ratio. Payout ratio is dividend per share over earnings per share, correct? Now we are going to write how much is going to be the expected increase in dividends due to these adjustments. So we are going to write down the formula of expected increase in dividends. So how much is going to be the increase in dividend? For this, they have given the formula, right? We will also utilize the same thing, correct? But that depends on how far are we from the payout ratio. Understood, everyone? So every company has some earnings, EPS, from which it is going to pay out something, right? So EPS into payout ratio is the dividend, but which payout ratio? The target, the long-term target payout ratio. So EPS into target payout ratio, this is what the company desires to pay out, right, everyone? But recently the company probably have not paid out this much dividend. So the difference between this and the company dividend that it recently paid, or the previous paid dividend, which I call it as D0. D0 is recently paid or previously paid dividend. This is the difference between what the company expects to pay and what the company just paid. This difference, the company wants to reach over a period of time. That time period is called adjustment factor, and this time period is what you can multiply with the adjustment factor, or I simply divide it by n. Now what they do is that instead of this, they multiply this with the adjustment factor. So I will just help you understand what exactly this is. Okay. So see this, this is expected increase in dividend, right? It is this into the adjustment factor. Adjustment factor. And what is adjustment factor? Adjustment factor is nothing, but it is simply 1 divided by n. And what is this n? This n is the time that it's going to take for the dividend to be adjusted. Yes. So adjusted factor is nothing but the number of years the adjustment will take place. I'll write down, it is number of years taken to adjust the dividends. So this difference needs to be sorted out in how many years. That is what is going to be my N, which they will provide you. Correct? That will be my expected increase in the dividend from the last year. So my expected dividend, which now I call D1, the next year dividend, okay, is actually nothing, but it is related to last dividend. Correct? Correct? Plus what I just calculated is the expected increase in dividends. Understood, everyone? And this expected increase in dividend is nothing but year. So that is going to be my expected dividends, D1, D1. Now I will show you how exactly this is connected, so you don't have to memorize all of this at all, right, in a moment. So first of all, see, check here. What is my expected increase in dividends and what is the adjustment factor? Let me do that without formula and explain you that. So last year, company had earnings of 3.5 per share and a pay dividend of 0.7. So what was my original payout ratio? My original or current payout ratio, you can say, is my dividend is 0.7 divided by 3.5. So my current payout ratio 0.7 over 3.5 is 20% or 0.2. Am I correct? Right? Now, they said the company expects earnings to be 4.5 per share. So this is my E1, 4.5 per share. And therefore, in my formula also, when I say EPS, that is next year earnings. So, or you can write, this is E1, expected earnings, E1. You can just keep it EPS also, but I'll prefer to write E1, next year earnings. Correct? Now, the company has a 35% target payout ratio. Are we closer to the target, guys? Currently, we are paying 20%, but our long-term target is 35%. We are too far away, isn't it? Check, 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 check. Can you confirm? Are we close to the target payout ratio? No, that current payout ratio is 20%. Target payout ratio is 35%. We are too far away. They want to bridge this gap over the next 5-year period. So this 5 is going to be my N. So this has to be bridged over the 5-year period. So guys, my expected earning is 4.5. On this, the target payout ratio was supposed to be 0.35, but the recently paid dividend is 0.7. This difference, I want it to be adjusted over the 5-year. That is going to be my increase in the dividend. So 4.5 into 0.35, correct? 1.57 minus 0.7 divided by 5, that is 0.175, should be the increase in the dividend from the last year. So the last year was 0.7 plus this, that's going to be my D1. So this is going to be my expected D1 or expected dividend, and this is going to be my increase in the dividends. Understood this formula, everyone? Correct? Right? Now, one very interesting thing. What is going to be now my payout ratio? Now, if I'm going to give this as dividend 0.875, what is my expected earnings, guys? 4.5. Check out how much is this in terms of payout ratio? 0.875 divided by 4.5. You will notice an interesting thing that your payout ratio is 19.44. Now, you did give this extra dividend with the hope that my current payout ratio, which is 20, will move closer to 35 long-term payout ratio, isn't it? But in reality, you have actually gone farther away, isn't it? Isn't it? Now, this sounds very confusing to many students. So they said, don't worry, it's not an issue here. Okay, it looks like it is an issue. So they are saying that target payout ratio adjustment approach is expected to work in the long run, even though year-on-year results may not match the logic. So currently, it's not, the payout ratio is not reaching to what my desire is. It's going actually farther away. But that's not the case. My dividend is increased. And by how much is the increase? By the time in which I want to cover the gap. Are you getting this point, everyone? Check, check, check. Understood? Now, this is completely in contrast to the constant payout ratio, which is theoretically correct, but rarely companies do this. Understood, everyone? Got it? Clear? And the formula, everyone. So you can either multiply this with the adjustment factor. So the original formula is this. I will highlight this for the expected increase. Or instead of adjustment factor, you can completely divide all this by n. So what I can perhaps write here, and I'm sure you will not mind it, the original formula which they have given is that instead of expected earnings, I can now directly write, see this, I'm not doing anything different. I can directly write here my E1 into target payout ratio minus D0, this whole stuff divided by N. By doing so, you will get the same result. Understood, everyone? Check, check, check. Clear, 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 clear. Right, everyone? So it's the same thing. Got it? Correct. Now let us see if there is any question related to this. Yes. See this question number 5. Everyone with me on question number 5 visible? Check this. Last year, Wolverine Shoes and Boots had earnings of 4 and paid a dividend of 0.2. This was my past earning and this was my D0, past dividend, right? Current year expects to earn 4.4. This is going to be my E1. The company has a 30% target payout ratio. So out of 4.4, the company wanted to pay a target ratio of 0.3, 30%. However, the company just paid how much? 0.2. They want to bridge this gap in how many years, guys? They want to bridge this gap in 8-year period. So I'll divide by 8. That should be the increase in the dividend, isn't it? They are asking me what is going to be the next year's expected dividend. So guys, in order to find D1, I need to add D0 also. And what is my D0? My recently paid dividend is 0.2. So when I'll add something to 0.2, that's the increase. Can you calculate how much should be this, everyone in the class? So 4.4 is my expected earnings. Of that, 30% was my target payout ratio. Recently, I paid 0.2 dividend. So I subtract that. I want to bridge this gap in 8 years. So that is 0.14 plus zero point 0.2. I will get 0.34. That should be my dividend. Are you getting this answer? That should be my expected dividend. Instead of paying 0.2, I will increase the dividend by this. Check, check, check. Let me know if you get this answer. Got it, got it, got it. Everyone? Yes, confirm. Easy, correct. Very important, very high chance of something like this being asked in exam, right? This is how we will decide whether the target payout ratio should be constant or should be adjusted over the period. Theoretically, it is constant, but practically what companies do is that they adjust because no companies wants to strictly maintain the payout ratio. Got it, everyone? Right? That's not sensible in most of the cases. Clear, everyone? Right? Okay. Now, what is the recent trend in the corporate world when it comes to the dividend payout policies? Right? They have asked something related to the past, but it's very simple. What is the trend? Of course, every country has their own trend, so it differs across the countries over time. But globally, it has been observed that developed markets proportion of companies paying cash dividend has shown a downward trend. So what you will notice, cash dividend trend is going down, especially in the developed market world. Correct? But on the opposite side, you will see the stock repurchase trend is going up. So the stock repurchase trend is shows that the companies these days are going for more of repurchase. Understood? Major companies in Asia have made substantial repurchase. you will see this trend. Of course, it was already existing in the West, but now Asia has also been coming to the point where the repurchase has been increasing off late. Understood? This is the recent trend. And there is an actually question that I just encountered related to this also, right? Over the past 25 years, in the developed market, including US, UK, and European Union, the fraction of companies have gone for more repurchase, right? The fraction of companies that pay out cash dividend has decreased, yes or no? Repurchase shares has decreased, no. Use particular dividend policy has been consistent, no, not consistent. In fact, what has happened? Cash dividend have gone down and repurchases have gone up. Understood? So A is the answer. Check, 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 check. Clear? Got it? Question number one, right? So since off late, also what I showed you of with respect to Apple, that once you pay dividend, you constantly have to keep the shareholders happy by paying more dividend. That's why what Apple initially also did and what Apple now does is that instead of paying more dividend, it rather focuses on share repurchase. So it is actually accumulating its shares back and controlling the shares. Yes. So we will discuss what are the motives behind share repurchase. We will discuss how share repurchase is actually executed and what is its effect on the financial statement. A very, very interesting thing. That's what we are now going to learn. Share repurchase. Share repurchase, again, I will repeat, is also called as buybacks in many countries. So don't get confused if you come across these words simultaneously. So overall, there are four methods of doing share buybacks. Okay. These methods are very common in some countries. For example, they said that though due to varying rules, some markets may not allow all methods, right? So it's completely based on the rule. They are saying outside US and Canada, method one is used almost exclusively. So the most common method globally, right, is the open market transaction, very much similar to IPO, isn't it? What happens in an IPO, guys? What happens in an IPO? In an IPO, guys, companies issue the shares and investors subscribe to the shares, right? But that is the point where they bid. So in exact words, it's not an IPO. IPO is some other type of method. So what is share repurchase? Share repurchase is generally a situation where the company is going to announce that, hey, I want to repurchase either some or all of the shares back. Now, how it is going to execute that, that is the four methods that we are discussing. Now, under the open market transaction, which is considered as one of the most flexible method with no obligation to the company. So this is a most flexible and no obligation method or no obligation option, right? Here, what happens in open market transaction, everyone? It allows the company to buy its shares in the open market at most favorable terms. So I can pick up the shares from the open market. I means the company can pick up the shares from the open market as many as I want and at whatever price as I want. So there is no obligation to complete and announce buyback program. So if I announce that, hey, I have 100 million worth of cash, so I can buy as many as I want without any restrictions. Correct? Here, European and American companies do not need shareholder approval for open market transactions. So, unlike their European counterparts, why is this not common in Europe and US? Because under Europe and US, there is an approval required. In other parts of the world, unlike their European counterparts, American counterparts do not require shareholder approval. So yes, I might have mistermed myself. So here there is no shareholder approval required. So basically, I can announce the buyback and I can do the buyback as much as I want at whatever price shareholders are willing to offload. So This is the most easiest option where, again, I will repeat, we announce the buyback. Whosoever wants to subscribe, they can subscribe. And those many shares, I can get it back either at the entire amount or whatever amount I get the buyback feasible. No restriction. This is called open market transaction, the most flexible approach. But generally, what I have myself also experienced is not an open market transaction, but it's a fixed price tender offer. So the buyback is announced at a fixed price. Yes. So the firm buys predetermined number of shares at a fixed price, which is generally at premium over the current market price. Yes. This is what I also encountered when I was dealing with companies in India, where this is the most common method actually, where the company has announced that, hey, we are going to buy back 10 million shares at, let's say, $20 each share. So basically, it's a $200 million buyback. Okay. Now, this buyback here, the number of shares and the price is generally, the price is here premium to the market. So what happens that people are excited to offload the shares because the company is determined that it wants these shares. So let's say the actual market price might be 18, but the companies announce a buyback at 20. What happens? The share price starts jumping because people see this as an opportunity. So it's considered as a very positive sign. Here, the company forgoes flexibility. It is giving up on flexibility. So what is the advantage? The advantage is that it allows the company to do it quickly because investors are very much happy to execute it. So if you want to do the buyback quickly, you go for this option. So this is quick and costly if it is at premium. Understood? So this is more about the need. If the company wants it to be done quickly, then it will go for the fixed price tender offer. Here, there is so much of a euphoria or excitement about the buyback that actually what happens is that people who want to offload their share, there is something like what we have oversubscription to buy the shares. Here, the company will do what? If the company gets more requests, then like IPO here, the company will do what? Company will do pro rata buyback of the shares. So let's say company announced a buyback here for 10 million shares, but it got bid for 20 million shares. Then the company will do pro rata, means company will give take only half of your shares that you had offered for buyback. So if you want to do it quick, go for fixed price tender offer. If you don't want any restriction, go for open market transactions. Clear, everyone? Right? And then one common process is Dutch auction. Wow, what is Dutch auction? Dutch auction is similar to what we did in the tender price offer, where you are going to tender the shares that you want to take up from the market, but here not at a fixed price, rather a range of price. So minimum clearing price is set up, correct? And investors will do what? They will bid. Here, I would say rather they will offer. Instead of bid, I will say offer because they're giving up the shares, right? So what will happen here? Investors will offer and those prices are accepted by the company until the bid is completely filled up, right? So who gets first the shares? Who gets the shares offloaded the first? The one who's gonna be ready to sell the shares at highest price or lowest price. Remember, here in buyback, you are going to sell the shares, company is going to take it back from you, right? So here, the one who is actually going to sell the share at the lowest price will first get the quantity. Are you with me, everyone? Correct? So the first lowest price, then slightly higher, then slightly higher. So the price that the last offer is accepted, which is the highest accepted bid price, that becomes my cutoff rate. Cutoff rate. Now they don't use the word cutoff rate, but that will become my price at which all the shares are tendered. Yes, all the shares are tendered. For example, let's say I'm willing to offload my share. Let's say the current market price is 20. Okay. I put the best bid. My bid was to sell the shares at current market price is 20. My bid was for 19. Someone else put the second bid was for 19.25. Third was for, let's say, 19.5. Let's say we close it at 19.5. So that 19.5 is my cutoff price. Understood, everyone? Clear? Now, even though I bid for 19, because the cutoff is at 19.5, my shares will also be offloaded at 19.5, and any extra amount that I paid or I offered to paid will be adjusted. Understood? So I will be receiving 19.5 for each share rather than 19. Here, shareholders can increase their chance by how? By bidding for lower price. These can be accomplished rather quickly, though not as quickly as tender offer. So tender offer is quick. This is relatively quick, but not as quick as the fixed tender offer. So even when you want to go for quick offloading of the share, quick buyback of the shares, you can go for Dutch auction. Dutch auction is a bit time consuming, honestly, related to compared to the fixed price tender offer. But then there is a possibility that you might get a good value. Correct? But if you want to do the buyback directly with some institutional investors, instead of doing that at a mass scale, you can do that by doing repurchase by direct negotiation. It's like a private placement for selling the shares of IPO, right? IPO is public issue, private placement. So same way here you have repurchase with direct negotiation, where major shareholders often at a premium over the market price. So you buy back at premium generally, correct? But here, this method is used in a green mail scenario. Yes, when there is an hostile takeover, everyone. So this method is generally used by company when a big prominent investor who is probably bullying your company, like what Elon Musk did with Twitter, and you don't want such an investor to take over your company. So this investor has probably around, let's say, 10% stake. So you don't want this investor anymore with the company, and forcing your company to be controlled by him. So you offer this guy that, hey, can you offload your shares? We are willing to pay you 20%, 30% premium. Now, if he agrees or she agrees, then great. Then this big investor is out of the company, right? So generally, this method is used to throw out some dominant bullying investor from the company, from taking over the control of the company. A negotiate purchase is generally also used under this case, but it is also used when the company wants to remove a large overhang in the market of dampening share price. Yes, we are going to learn in detail that the share repurchase or buyback is going to jump the share price. Per share price will increase. Why? Because the denominator, market price per share, in that the number of shares reduces. So one of the reason along with hostile takeover is also to boost the share price. Understood? Correct. But we discussed that this is done at premium, right? Correct. You offer premium. You offer premium when you are in the need of that shareholder to offload the shares and exit. Correct. However, sometimes when the companies are desperate to do the buyback, then then in that case they are willing to pay you high price also. Correct. Right. Surprisingly, however, they are saying many negotiated transactions occur at a discount, indicating urgent liquidity of the seller. So if a big seller wants to exit, they are willing to do that at a discount also. So there was a very big issue in India in terms of Tata Group, where Tata Sons didn't had the majority control. The majority control was with Shapurji Palanji Group, which was actually at loggerheads with the Tata board, and they were making their life miserable by being the biggest shareholder. So Tata Group wanted this group out of the company, right? And the SP Group also wanted to exit Tata Group. Both wanted to, you know, happily get divorced. But the SP group was losing a lot of value because the Tata group was seeking more and more control. So it was ready to do the buyback. It was ready to offload its shares even at discount because they wanted liquidity. They thought that their money stuck for a very long period and they can't do anything because of so many restrictions put by the Tata group. So they wanted to exit the company. So they were willing to exit at discount also. Understood, everyone? Correct? Clear, clear, clear. Okay. Now we are going to understand what is the effect of buyback. First, we will understand what is the effect of buyback on EPS. And then, very interestingly, we will understand the effect of buyback on book value per share. So first EPS, and second we will discuss the impact on book value per share, earnings per share and book value per share. Very high chance of this being asked in exam from this very short sweet topic of corporate issuers. Okay, very easy also. First of all, see, when the companies do buyback, the cash goes out of the company, isn't it? So companies will only go for buyback if they have surplus cash. But does it affect the earnings? No, it doesn't affect the earnings as long as the buyback is not funded by debt. Assuming there is no debt, it doesn't affect the earnings. But as the company's cash goes out, correct? The shareholders' equity will also be reduced. So the company's leverage increases because the equity in the denominator goes down. Correct? But once the buyback is completed, earnings per share might increase. And what can be the reason? Because as I said, the earnings are not affected, but the number of shares will be reduced. So per share earnings will increase. Let us see that. How does that play a role? Everyone. So company is going to first do what they are going to. Yes, equity will be affected. Why? Because the money goes out of the system whenever there is a cash dividend or there is a buyback. It's not a stock dividend, but the earnings per share will jump. So see, this company has 10 million shares outstanding and just reported a net income of 50. Okay. So company had total earnings of 500 million. Because the company has 100 million of excess cash and currently earning no return, same like Apple, at one point of time had $245 billion cash. $245 billion. That's massive. That's equal to so many countries GDP put together. Okay, so if there was a very funny quote at that time that Apple's cash pile is equal to more than 100 countries GDP, some of the poor 100 countries. So that is what Apple's giant cash pile was. $245 billion dollar. So here the company has 100 million of cash which it can utilize for buyback. Correct? Now, company's directors are considering repurchasing 2 million shares at a premium of 25% of current market price of 40. So current market price is 40 and plus premium of 25%. So company is going to take the shares at 50, correct? So that is going to be my buyback price. So how many shares it can take? It has 500 million, right? And each share it wants to take at 50. So basically, how many shares they will be taking up? They can take up 2 million shares, isn't it? 2 million shares they can repurchase because they have a cash pile of 100 million and they are willing to take it at $50 per share. Correct? Correct, 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 correct. Yes. So basically, 2 million shares can be repurchased. So after repurchase, how many shares I will have, everyone? Before I had 10, after repurchase, 10 minus 2, we will have 8 million shares. Clear? Right? Calculate and compare the effect of repurchase on EPS when the repurchase is financed using existing surplus cash. And what if you didn't have cash? Then you can do this by borrowing. But when you do borrowing, you will have to pay interest. Yes, this is an interesting part. Okay. So we are going to understand what is going to be the effect on the company's EPS if you use your own cash or if you borrow. Well, if you are going to use your own cash, tell me one thing, the EPS calculation. What is the EPS formula? Net income minus preferred over number of shares outstanding. We actually write weighted average shares outstanding, but imagine here it's simply number of shares outstanding. After buyback, there will be no effect on net income, but the number of shares outstanding will reduce by the buyback shares. That will be the only adjustment. So my net income, which was 50 million, will remain the same, but the number of shares have reduced. So what will happen to my earnings per share? It will increase, isn't it? But if I use debt, then this 100 million will be funded at 3%. So basically, I'll have to pay 3 million of interest, after tax interest, which will reduce my net income, isn't it? So now, in this case, my earnings will be net income. Initially, it was net income over number of shares, but now, along with buyback shares adjusted in the denominator, interest after tax interest will also be adjusted from the numerator. So my earnings will also go down and denominator shares will also go down. So what will happen to my new EPS? It is higher, but not as high as utilizing the surplus cash. But again, my EPS has increased. Yes or no, everyone? Correct, correct. So now there is a connection about this. Everyone in the class, what is the connection? Here, if you check the earnings yield, what is earnings yield? Earnings yield is earnings over the price. What was the earnings of the company? 50 million, correct? And what was the share price of the company? 40. So if you see earnings per share, 50 million over 10 will be 5, right? 50 million earnings per share initially was 50 over 10, that is 5 earnings per share, and market price was 40. So if you do 5 divided by 40, you get your earnings yield of 12.5, isn't it? This is the situation before. 5 was my earnings and the market price was 40. But they are saying earnings yield before the repurchase, EPS over the price paid per share. If I do the buyback at 50, my earnings yield as an investor, I will get an earnings of 5 per share and the buyback price was 50. So in that case, the earnings yield I receive is 10% if I go for the buyback. Now, this is the advantage in the buyback that an investor has, or the company's earnings yield will be 10% if it goes for the buyback, which is still higher than the cost of capital, which was 3%. So, guys, your company's earning yield are higher than the, even at the premium paid, your earning yield is still better than the cost of capital or cost of debt, then buyback is a feasible option. Yes. Understood? So we are going to write about this. So buyback effect on first we will see EPS. So we will write EPS after buyback. Okay. It's going to be net income over number of shares. Okay. Here, net income minus interest, but interest will only come up into the picture. And when I say interest after tax, okay, this is interest after tax. This will only come up if buyback is funded by debt. Okay, otherwise not. Okay, otherwise no. But in the denominator, I will subtract buyback shares. Correct? Now, if the earnings yield, if I will write down here, if the earnings yield sorry, if the earnings yield, and what is earnings yield? Guys, earnings yield is earnings per share before buyback. Earnings yield, I will write earnings yield at buyback price divided by the buyback price. This is going to be my earnings yield, right? This earnings yield, if it is greater than this earnings yield, if it is greater than the after tax, whenever I say cost of debt, after tax cost of debt, then what will be the conclusion, guys? Then the conclusion will be that price after buyback will increase. Price after buyback will be higher. This is what the conclusion will be. Understood, everyone? This is the effect of buyback on the earnings per share. Is this clear, everyone? Check, 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 check. Right? So see this conclusion here. So we see that EPS will increase when the after-tax funding cost is less than earnings yield, or I can say whenever the earnings yield is greater than cost of debt, what will happen to my EPS? My EPS will increase. However, firm will then also have higher leverage and higher cost of capital. Yes. Why? Because the equity is going down. Why? Because the money is going out of the system. So, guys, that does not guarantee that the companies will become less risky. So, increase in EPS should not automatically lead to increase in share price or shareholder wealth. So, yes, EPS will increase, but because the company has become more riskier, there is a higher chance that companies' price might not be increased. Understood, everyone? Clear, everyone? Check, 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 check. Got it? Got it? Got it? Yes, this is the issue, especially when there is borrowing. Now we will discuss what is the issue with respect to buyback on book value per share. Remember, book value is nothing but the net asset value. Book value has so many different names. It is net asset value. It is total asset minus total liability. All of this is called book value divided by number of shares is book value per share, right? Here, if the price paid is higher, if you paid more, then what? Then the pre-repurchase book value per share. Then buyback is not beneficial. Then the book value per share will decrease because of the buyback. So guys, when you do buyback, you need to make sure that the price that you're offering in the buyback, is it more than the book value per share or less than the book value per share? So I will show you the example which they've given, but before showing you the example and doing the calculation, let me prove what they're trying to say, that what is the company's book value here, 15 and 25. But if I want to convert book value per share before buyback, 15 divided by number of shares is 1 million. So this will be 15 and this will be 25. This will be book value per share. So this is alpha company, this is beta company, right? This is my book value per share. This you need to compare with the buyback price, everyone. So I will have the book value per share. They said the numbers, the stock price is 20 and 20, right? Calculate the impact of the repurchase transaction. How much will be the repurchase? Consider two companies, alpha and beta. Both are considering the repurchase of 5 million worth of shares. Everyone, 5 million worth of shares, right? Now, what we notice is that before buyback, they've given me the book value was this 15 and 25. What will happen after buyback? After buyback, number of the first thing, the 5 million will go out of the system, isn't it? Correct? So, guys, whatever was your book value, that book value will be reduced by the buyback amount of 5 million. So see here, your book value after buyback will be reduced by 5 million in both the case. But that's not all. The number of shares will also be reduced, isn't it? Isn't it? Isn't it? So before buyback, you had here how many shares? 1 million shares in both the case. Now, guys, you are going to buy back 5 million, and the stock price for buyback is 20 in both the cases. So 5 million divided by 20, basically you're going to buy back 250,000 shares from the 1 million. So you'll be left with same number of shares. Right? 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 So if you now look at book value per share after buyback, this is your book value and these are the number of shares. So if you do this 10 million divided by 750,000, you will get a buyback price year and year. If you will notice, I will show you how to calculate this. How to calculate book value per share after buyback in a shortcut way. I will show you the shortcut way, same like earnings. Okay. Remember in earnings, what we did here? In case of earnings, we wrote this formula, net income minus interest over number of shares, right? Now, if I want to understand the impact of buyback effect on, book value per share. Okay, so likewise, what we did here, EPS after buyback. Now, if I write here book value per share after buyback. So first of all, book value per share is book value over number of shares, same like earnings per share. But then the amount that I'm going to buy back, right? The cash that I will pay or the number of shares into, the price that at which I'm going to buy back. That cash utilized to buy back in this case, how much am I going to utilize? I'm going to do buyback of $5 million. So the cash used for buyback, or you can write here buyback amount, which can also be calculated as number of buyback shares, times the buyback price. If they don't give you this, you can calculate this, the amount that you're going to buy back. This will be going out from the company's total equity, but the denominator will also be adjusted by the buyback shares. So due to this, of course, the book value per share will increase, but the criteria for the book value per share increasing, the book value per share after buyback will increase if very interesting thing. Of course, you will figure out when you do the calculation, but what are they trying to say? This will increase. See here, this will increase. If the price paid is higher than the pre-purchase, the book value will decrease. So price paid. So if the price paid here, I'm going to pay 20 and the book value per share before was 15. Good thing or a bad thing? The company share price was higher, okay, and the book value per share was lower. So here, if you do the buyback, it's a bad thing for the company. What will happen? Book value per share will reduce. Why is that so? And on the other end, the book value per share before buyback was 25, but the company gave the buyback at 20. So that's benefit for the company because company is giving less shares. So yes, if the company's buyback price is below the book value per share pre-buyback, then it's a good thing for the company. Company is giving you less shares, isn't it? Company is giving you less value. So company's book value in this case was 25 and the buyback price was 20. So if the buyback price, if I will write down here, so if this will increase only if the company's buyback price is below the book value per share pre-buyback. If this is the case, then it's a good deal by the company. Why? Because the company did the buyback at the lower price. The book value per share, see, check out. In this case, the book value per share of the company before buyback was 25, but the company did the buyback at the stock price of 20. So here, again, I will say the company's buyback price was lower than the book value per share pre-buyback. Due to this, what happened, guys? Due to this, it was a very smart decision by the company, and the company was able to do that. Due to this thing, eventually what happened? The book value per share after buyback actually increased from 25 to 26.67. And opposite will be the true in the other case. Understood about this? The book value impact? Check, 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 everyone. Right? Not so easy, but understood, understood, clear, clear, right, everyone? So we have to understand that book value per share and earnings per share, they both will jump after buyback. But if it matters whether they are funded with debt, if they are funded with debt, then you need to compare the earnings yield, everyone, earnings yield and the after tax cost of debt. If the earnings yield is greater than the after tax cost of debt, it's a good deal. So the EPS after buyback will go up. Price after buyback, everyone. I've written price after buyback. Is it price after buyback will go up or earnings per share after buyback will increase? Here, instead of price, I should write earnings after buyback should increase. Clear? Same way in case of book value per share, what will happen? That if you are able to do the buyback at cheaper price than the current book value per share, then it's a good deal. Then the price and then the book value after the buyback will jump up, will increase. Got it? Right. Now, the conclusion, the battle, whether the company should go for cash dividend or repurchase. This is a choice that the company will make, not the investor. The company will make this choice, right? When should we go for which option? Well, it is based on 5 factors. Number one is the tax advantage. As we already discussed that since dividend tax are higher in many countries, capital gains are preferred, right? Correct? So when the tax rate on capital gain is lower than dividend, everyone, share repurchases will be preferred. Correct? Also, share repurchase. Company is repurchasing its share. That means company is more confident about its own shares than others, right? So see, many times when the director or the company's promoters are running away, they offload the share. But here the company is repurchasing its own share. So it's viewed as a very positive investment because the company is more confident. And we all know that company has more information than the investors, right? So if company is buying its shares, that's a signal that company's value is undervalued and therefore the company is going for buyback. Correct, everyone? Also, sometimes when the share price is too falling, to control the rumor or to control the false narrative, the companies does a tactical signaling by buying back the shares. Clear? Also, as I said, flexibility. I showed you Apple's status where Apple does not want to, in the past when Steve Jobs were there, they didn't wanted to pay out cash dividend and put this habit to the investors. So they wanted more flexibility with the money, and therefore they preferred to do repurchase rather than cash dividend. Of course, eventually they fell up into that trap. Understood? Correct. So with the leftover earnings, you can do whatever you want if you are doing repurchase rather than going for stock dividends. Also, when you're giving a lot of ESOPs, employee stock option plans, you know there is going to be a dilution. So to balance that dilution, what companies can do is that they can go buyback. So again, Apple's example you can take, it is giving a lot of ESOPs to its employees, or even many tech companies are doing that. So to stop that dilution, you can do the opposite, is that you can do the buyback. So that will balance out. Got it? And finally, leverage. Buyback will do what? Buyback will make the company more leverage or less leverage. See this. Whenever there is a debt funding, so what companies do is that they borrow, so they increase their debt and they buy back the equity. So actually, in a debt equity ratio, when you borrow, your debt goes up. And if you do buyback, your equity goes down. So overall, your leverage increases, isn't it? So companies who probably want to restructure their capital and they are in the position to increase the debt, or let's say their debt equity ratio is very low and they have the potential to increase it, so they can change the company structure by decreasing the percentage of equity and adding more debt. Of course, it's very risky, but companies can do so. Got it, everyone? Right? Now we will see the scenario, two scenarios where we will see the impact of share repurchase and cash dividend. We'll compare both, correct? And we'll compare both in two scenarios. Everyone, cash dividend, share repurchase, when the cost is higher or the cost is lower. That is also we will compare cost compared to the earnings yield. So let's do that. So in this example, we will cover both the scenarios. First, we are being given the information. Now, of course, I can go directly backside and do the questions, but let's see this. Company has 20 million shares with a current market value of 50. Company made 100 million in profits, since only 70% of these profits are reinvested. So guys, out of 100, 70 is going to be reinvested. So guys, 30%, that is 30 million, can be distributed as dividends, isn't it? Correct? Or can be done as buyback. Correct? Correct. The board of directors is considering two alternatives for distributing the remaining 30%, right? Correct? Pay a cash dividend of 30 million or for 20 million shareholders, that is 1.5. Guys, if I pay cash dividend, what will happen to the company stock price? The company stock price was 50. If the company is going to pay cash dividend of 1.5, X dividend share price will be 48.5. Easy? Correct? So as an investor, guys, now I have 1.5 of cash dividend and 48.5 in the stock. My overall wealth will remain the same. You can go through this calculation. The overall wealth is not affected, isn't it? This is what was mentioned by dividend irrelevance, Modigilani Miller. Correct? Right? But the second option is repurchase 30 million worth of common stock. Now, for repurchasing, we need to understand whether they are borrowing or not borrowing. Suppose the dividends are received when the shares go ex-dividend, the stock can be repurchased at the same market price of 50, and there is no tax treatment, no difference in that. So basically, they are not going to use any borrowing. They have the money. So they will use their own cash. Now, guys, whenever a company gives cash dividend or share repurchase and it utilizes its own cash, right? So there's nothing borrowed. Then in this case, let me tell you, whether it's cash dividend or stock repurchase, the impact is same. Yes. So in case of share repurchase, what will happen? Company initially had the market value of 20 million shares at 50, right? From that, they have decided to pay to do the buyback of 30 million, but the number of shares will reduce. How many shares they can buy back? With the 30 million at the price of 50, so 30 million at the price of 50, they can buy back 600,000 shares. So if you adjust that, you will get the post buyback price also at 50. No change. Here also it's 50, just that 48.5 is in the stock and you have a dividend in your hand of 1.5. So you will notice that the total wealth of investor is the same. This is what Modigilani Miller was saying. But remember, Modigilani Miller said that this is a situation assuming that there is no tax or no brokerage or no transaction cost. Then it has the same impact. But in a real world, we know that there are taxes and there are cost of capital. So then things might change. Got it, everyone? Right? So now what we are going to assume that what if the company borrows to fund the buyback? So instead of utilizing its own cash, what if the company borrows? And whenever the company borrows, two things you need to focus on is the earnings yield, and you need to compare that with after tax cost of capital. So I will first calculate what is the earnings yield and after tax cost of capital and compare it and get the answer in my head before I solve it. So let us see what is the earnings yield. Company is going to plan 30 million to borrow. It's going to borrow 30 million as a plan. Share price at the time of buyback was 50. Outstanding shares was 20 million. Same thing. EPS before buyback was 5. Correct. Earnings yield they have given was 10 percentage and after tax cost of debt was 8. Guys, my earnings yield was 10 percentage and after tax cost of debt was 8. So if my earnings yield is greater, then definitely after buyback, my EPS will, what will happen to my EPS, guys? My EPS will increase or decrease. After buyback, what should happen to my EPS? My earnings per share, these are the number of shares, correct? Before buyback, the EPS was 5. Because I'm going to buy back and my earnings yields are higher than cost of debt, definitely after buyback, my EPS will increase. It has become to 5.03. We've already calculated the EPS formula after buyback that from your total earnings, after tax cost of funds or debt is what you will subtract, and in the denominator you will adjust the shares after buyback. So 30 million on 30 million, guys, I will pay 8 percentage. This will be adjusted in the numerator, and in the denominator, out of this is what will be adjusted from the earnings. And in the denominator, what will I do, guys? In the denominator, whatever shares I had initially from 20 million, whatever shares I'm going to buy back, 6.6 million, that will be adjusted. So if you do that, you will get to know that the earnings per share has increased, and that's because of the comparison of earnings yield and after tax cost of debt. But in the second situation, they have given me a situation where the cost of debt is higher than the earnings yield. Yes, notice this. They have said that the company is doing the same thing, but at the cost of capital of 15 percentage or cost of debt at 15 percentage, then my EPS will go below 5. Understood, everyone? Same thing that we studied. Check, check, check. Clear, 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 everyone? Right? Got it? Now, let us understand this through an example that how will this be taken into consideration. Okay, let's see this. Do we have something to? Yes, see this. Question number 3, everyone in the class. Companies recommending, okay, profits, excellent share profits from a year totaling 56 million, which shareholders by either declaring a special cash dividend of 20 million or using the 20 million to repurchase the shares. So 20 million cash or 20 million repurchase. Okay, selected financial statement, shares outstanding 40, current stock price 52-week trading range is given, book value of equity is given, after tax cost of debt is given as 5.5. Everyone. Okay. After Adams drafts a memo, okay, declaring, okay, financial impact of declaring special cash dividend versus repurchase. His memo includes the following statements. Total shareholders' wealth resulting from owning one share of stock with the special dividend option will increase to 28.5. Guys, when the companies give cash dividend, your share price will increase by dividend or decrease by dividend? Increase by dividend or decrease? First of all, will it increase or decrease? Will it increase or decrease? The problem is this with this word, it will not increase, it will decrease. Am I correct? Yes or no? How much was the dividend? 20 million. And how many shares I have? 40 million. So my dividend per share is 20 over 40, that is 0.5. So my ex-dividend price should be 28 minus 5. It should be 27.5, not 28.5. It should decrease. So statement number one is right or wrong, everyone in the class? Check, 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 confirm and tell me. Statement number one is wrong, correct? Look at statement number two. Our company's P ratio after the share buyback will remain the same as before buyback. Now, guys, in the PE ratio, we need to focus on the earnings. Earnings. So before and after buyback, my earnings, if they both are not same, before and after buyback, if they both are not same, the P ratio will not be same, right? Correct. Now, guys, don't you think that depends on something? What is that? Depends on the earnings yield and after tax cost of debt, isn't it? So if they both are not same, will the earnings be same? No, the earnings might increase or decrease, isn't it? Isn't it? Isn't it? Everyone. So it does matter what is the earnings yield, everyone. Correct. So what should be my conclusion here? What is going to be my conclusion? My EPS before and PE ratio based on that EPS, and EPS later after the buyback is done. Okay. If the earnings per share is increasing, my PE ratio won't be the same. Understood, everyone? So you can calculate the earnings per share before and after the buyback. Our company's P ratio after the share buyback will remain the same as before share buyback. Guys, here we have been given cost of borrowing, but we know we now need to see the earnings yield. What is my earnings? Earnings. Shares outstanding was 56. So if you calculate your earnings, 56 divided by 40, you had 1.4 of earnings, correct? And price of the company was, market price of the company was 28. So your earnings yield 1.4 divided by 28. Earnings yield was 5%, and after tax cost of borrowing is 5.5. You notice, everyone? Correct? Earnings yield, company that they will share the profits from an excellent year, totaling 56 million. Right, everyone? Everyone? Correct? So what is happening? My earnings yield was 5%, 56 million divided by dividend, special dividend of 20 million, right? So 56 divided by 20. Yes, that was, oh, my mistake. 56 million divided by 20. It was 2.8. I'm so sorry. This is 2.8. And market price was 28. So my earnings yield is 10%, correct? Still, when my earnings yield is greater than cost of borrowing, my EPS will what? Will increase. I'm so sorry. My earnings 56 divided by 40 million shares. My earnings per share was 28, 2.8, and market price was 28. So earnings yield is earnings over price. That is 10%. It is greater than cost of borrowing. So guys, my EPS will increase and therefore my P ratio will go down. So it will not remain the same. So both the statements are wrong. Neither of the statement is correct. Understood, everyone? Correct. P ratio will, before and after buyback, P ratio will fall because the EPS will increase. Why will the EPS increase? Because I don't even need to calculate. I can just compare the earnings yield with the after tax cost of debt and I will get the answer. Clear, everyone? Understood? Got it? Look at question number 4. We can try question number 4 also. We've done first, we've done third, we can do fourth, we've done fifth. Which of the following would not be a good reason for a company to repurchase shares of its own stock? Means you have to look out which is not the Good reason. Okay. Management believes a stable cash dividend is best. Believes its stock is overvalued. Guys, you do buyback when the stock is overvalued or undervalued. You do buyback when you think the stock is undervalued. So this is definitely a wrong statement, isn't it? So this can definitely not be the reason of doing the buyback when you think it's overvalued. And if you do buyback, you're actually buying at a higher price. When it's undervalued, buying it makes sense, right? Wants to increase the amount of leverage and capital. No, that is not the reason of doing buyback. Buyback is when you want to give a signal. When management wants to give a signal, that's the appropriate reason for buyback. Correct? Correct? Yes. Finally, we are going to understand the impact of buyback on some of these ratios, right? So, which ratios? We are going to cover the dividend coverage ratios, correct? These dividend coverage ratios are called dividend safety, which basically tells the probability whether the dividends will continue or not. So under this, there are two ratios which are actually the same, but the formula is inverse. That is the dividend payout ratio. We all know what is dividend payout ratio. It is dividend over earnings. And sorry, inverse of it is called dividend coverage ratio. Very interesting. Dividend coverage ratio is actually earnings over dividend. So you will see it's net income over dividends. And then there is another ratio, which is free cash flow to equity related to FCFE, which is FCFE coverage ratio. I will write down all the ratios, everyone. So the dividend safety ratios, which includes the dividend payout ratio. And the inverse of it is dividend coverage ratio. Everyone. So dividend payout and dividend coverage. Dividend payout is dividends over earnings. Earning is nothing but net income. And the inverse of it, net income over dividend. Correct? Both are the same. There's no difference in it. Just it's one ratio is the inverse of the other, right? But instead of dividend coverage, dividend is completely paid from the earnings, right? So when I say dividend coverage, it basically tells me how much of the dividend do I have the net income. But same way, when I say FCFE coverage, FCFE coverage. So instead of net income, now I'm going to replace that with FCFE, and FCFE will not only take dividends into consideration, but it will take something extra, which we have learned is why only dividend, but it can also take share repurchase or buyback. So that's the change compared to dividend coverage and compared to FCFE coverage. Of this, I will just write down the formula of FCFE, which we've done in equity and throughout. Free cash flow to equity using CFO, net income plus non-cash minus changes in working capital minus fixed capital plus net borrowing. This is going to be your formula for FCFE, which you've already covered in equity by now. So this formula will give you FCFE and FCFE coverage and dividend coverage. What is the only difference in FCFE, guys? In FCFE, you also take share repurchase. In dividend, only dividends. That's the only difference. These three ratios we are going to study now, and we are going to see the impact of our decision on the company's these three ratios. Got it, everyone? So let's see this, everyone, directly. So we have Chevron Corp. Okay, fine. We are given 2 years result, 2009 and 2008. They have asked us using the information, calculate dividend payout and dividend coverage ratio. So guys, whatever is your dividend payout, just inverse it. So for using the information provided, calculate. They've done for both the years. I will just do for one of the years. So let's say for 2009, where is my dividends? And where is my earnings? So you just calculate that. Your dividend paid 5373 divided by 10483. So your dividend payout ratio will be 51% of 2009. And just simply inverse it. That's going to be your coverage ratio, dividend coverage ratio. Got it? FCFE coverage, for that I require FCFE, FCFE, FCFE. Now, if they've not given me FCFE, I can calculate FCFE for 2009 as CFO. How much is my CFO? My CFO is 19,000. Fixed capital I will subtract. Net borrowing I will add. So you will do 19,373 minus 19,843. Fixed capital subtract. Correct? Plus 1659 as net borrowing. Are you getting 1189? 1189. And when I want, first I will store this. When I want fixed FCFE coverage, I need to take two things. I not only need to take dividend, but I need to take share repurchase. Now, the interesting thing is that even though it's negative here, you have to make sure that you will perhaps do what? You will add both or subtract both. So here, if see this, here when I see the share repurchase is positive, that means it was a repurchase. But when I see this as negative, what does it mean? What does it mean? Can you tell me, being now a CFA level 2 potential chartered holder, when the share repurchase is negative, what does it indicate? Share repurchase is positive means the company repurchase, but when the share repurchase is negative, means actually the company issued the shares. Understood, everyone? Yes or no? Clear, 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 clear. So for 2009, I will FCFE coverage, I will take this and divide it by the net of these two. So 5373 minus 168 to 2, recall 1 divided by recall 2. You will get an answer of 0.2284, that is 0.23. Now, of course, you can calculate this easily, but see the trend. What's happening? The payout ratio has increased. Correct? Of course, so then the coverage ratio will fall. FCFE coverage ratio has also fallen. What do you think? Is it a positive thing for the company or negative thing for the company? Everyone in the class, they are asking me, discuss the trend in dividend coverage and compare it with FCFE coverage ratio. What will I say? Both are decreasing significantly, isn't it? Year on year, right? Correct, correct, correct. But is this decrease or increase too high or too low? See, when it comes to FCFE coverage, they are saying a FCFE coverage ratio less than 1 is considered unsustainable. Yes, so if this ratio is below 1, it is considered unsustainable. Keep this in mind. Understood? So when I say FCFE, this coverage ratio, okay, note FCFE coverage below 1 is considered unsustainable. Company cannot survive for long if their FCFE coverage ratio is so low. They can neither pay dividends nor they can do repurchase from their FCFE. So that's a bad signal. So here, what I see is the FCFE coverage ratio is also below 1, isn't it? Correct, correct. It's already below 1. So that's a bad signal, isn't it? Is Chevron's dividend sustainable? Guys, what will I say? Is the dividend sustainable? The company has increased the payout ratio, guys. Company's profitability is going down, but it is increasing the payout ratio. So isn't it doing a stupidity, right? Chevron's dividend coverage ratio has decreased. Still with decrease, the dividend coverage is almost 2 times. So they are saying it's not a concern. However, is it sustainable? So conclusion you will see is that it suggests that the Chevron's payout policy is unsustainable in the long run. Understood? Because its profitability is falling and its payout ratio is increasing and its FCFE coverage is below 1 and it is deteriorating. So it's not sustainable. Understood? Correct? Right? So its decision is inappropriate. So look at this. Which of the following is most likely to be sustainable? FCFE coverage ratio of 0.5? No, it should be greater than 1. Dividend payout ratio less than 1 is good. Dividend coverage ratio should also be higher, right? See, ideally, these both our coverage ratio, and coverage ratio should be at least greater than one or more, right? Then it is sustainable. But so in this case, both are below one, so they are not sustainable. But a payout ratio of 0.5 means the coverage ratio is 2 times, which is sustainable. Understood? So the only thing sustainable is B. Got it, everyone? Clear, 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 right? That's the end of one of the very easy but very interesting topic of dividends and share repurchase. There are a lot more formulas which is going to come up in the corporate issuers, but very easy after you do equity and other topics. Correct? Yes. Perfect. Anyone has any questions till this point? Any doubts? Let me know. Yes. Very easy topic. Got it? Yeah. Thank you.